As we check the live market, Rezolve AI PLC, trading under the ticker RZLV, is currently at $3.345 per share. That is down about 2.19% on the day, or a loss of roughly 7.5 cents. The stock has been volatile during today's session, opening at $3.41, hitting a high of $3.49, and just recently touching a low of $3.30. What's driving this action is the nearly 3 million shares that have already changed hands, which is a significant volume for a company of this size, though still below its 30-day average. Now, you might see that $3.34 price, see the AI in the name, and think you found a ground floor opportunity in a hot sector. The immediate expectation is that this is a small, undiscovered tech company on the verge of a breakout, maybe the next firm to follow the path of a monster like NVDA stock. But the reality of what's happening with RZLV is far more complex and, frankly, much riskier than that simple narrative suggests. What you're actually looking at is a very recent de-SPAC, a company that came public through a merger, and it carries all the volatility and narrative-driven chaos that comes with that territory. This isn't a simple case of self-investing in a new tech. It's a high-stakes bet on a company with a market capitalization north of $1 billion, but a financial footprint that is almost microscopically small in comparison. The common belief, and the one the company is actively promoting through a heavy stream of press releases, is that Rezolve AI is set to lead a transformation in e-commerce. They use the term Agentic Commerce, which is a label for AI-powered shopping agents that can understand consumer needs and make purchases autonomously. This is the big story. They've announced an acceleration of their U.S. expansion, they've highlighted the hiring of a former Microsoft executive, and they've even pointed to comments from Amazon's CEO about this type of commerce as validation of their entire business model. When investors, especially those new to online investing using a Robinhood app or a SoFi Invest account, see this, they see a company with stated partnerships with Microsoft and Google. They see Wall Street analyst ratings with firms like Maxim Group and Roth Capital setting price targets at $15 or $12.50. The expectation becomes, this is it. This is the stock that could turn a small investment into a major windfall. But then we have to look at the reality, and this is where the picture gets deeply, deeply disconnected. The expectation is built on a future promise. The reality is rooted in the company's current financials, and they are, to put it mildly, staggering. While the company boasts a $1.1 billion valuation, its trailing 12-month revenue is just $5.3 million. Even more concerning, its net income over that same period is a loss of over $217 million. Let's let that sink in. The company is valued at more than 200 times its annual sales, not its profits. It has no profits. In fact, for every dollar it makes in sales, it's losing over $40. This isn't the profile of a stable, growing business like Apple stock, or even a high-growth, high-profit machine like Tesla stock. This is the profile of a speculative venture. The strong buy ratings you see are from the very same types of banks that often specialize in helping these smaller, high-risk companies go public in the first place. Meanwhile, more quantitative, algorithm-based rating systems, which are unbiased by relationships, flag the stock as a strong sell based on its weak fundamentals and negative momentum. This is the core conflict, a story of a trillion-dollar future versus a balance sheet that suggests a struggle for survival. Let's look closer at the recent stock movement because it tells the story of this conflict. In the last month alone, RZLV is down over 40%. In the last 5 days, it's down 18%. This is not the gentle, long-term climb that investors using Schwab Intelligent Portfolios or Fidelity Wealth Management Services are looking for. This is a trader's stock, being bounced around by news and speculation. The high volume we're seeing today isn't necessarily a sign of conviction. It's a sign of intense disagreement. For every buyer on a platform like Interactive Brokers betting on the Agentic Commerce stream, there's a seller, and potentially a short seller, looking at the $217 million in losses and betting on a crash. The company's 52-week range from a low of $1.07 to a high of $8.45 confirms this is a battleground. This is not a stock you park in Fidelity IRAs and forget about. The company's recent flood of news, attending investor conferences, announcing new hires, talking about a $200 million financing round, is a classic de-SPAC strategy. The goal is to keep the market focused on the next thing, the future potential, to draw attention away from the current cash burn. So, what does Rezolve AI actually do? Its core business is a generative AI platform for the e-commerce sector, which it calls its Brain Suite. The idea is to solve the massive problem of cart abandonment, where shoppers fill up online carts but never complete the purchase. Rezolve's tools, in theory, create conversational AI and visual search capabilities to engage the customer, answer their questions, and guide them to checkout. It's a valid problem to solve. But there's also confusion. If you search for the company, you may find Rezolve.ai, which is a different entity focused on internal IT and HR support, a service desk integrated with Microsoft Teams. RZLV is the public company focused on retail. This branding confusion doesn't help. The company was founded in 2016 and officially became Rezolve AI PLC in March 2025, cementing its public listing. This short public history means there is no long-term track record for investors to analyze. All we have is the recent post-merger volatility. When you look at institutional ownership, it's revealing. Only a tiny fraction of the company, somewhere between 5 and 8%, is held by large institutions, and many of those are likely just index funds like Fidelity ETFs or SoFi ETFs that are forced to buy a stock when it enters an index. This means the vast majority of the stock is in the hands of insiders and the retail public, the very traders on Robinhood stock trading platforms, which explains the stock's wild, sentiment-driven swings. This brings us to the future outlook, which is a tale of two complete extremes. This is the part of online investment that requires a strong stomach. The bull case, the one based on expectation, is that Rezolve AI is telling the truth. The company has put out enormously ambitious guidance. They are targeting a $150 million ARR rate by the end of 2025 and a $500 million ARR exit rate for 2026. If, and this is a big if, they can achieve this, then the stock at $3.34 is ridiculously cheap. A company with $150 million in high-margin recurring software revenue would be worth many, many billions of dollars. The bulls are betting on the Microsoft and Google partnerships are the real deal, that the new sales team will sign up major retailers, and that the $200 million in new financing gives them the runway to get it done. They believe the analysts at Maxim Group, who see a $15 price target, are right. The bear case, based on reality, is that this guidance is pure fantasy. The challenge is the math. To go from $5.3 million in TTM revenue to a $150 million ARR rate in about a year requires a growth of over 2,700%. That is almost unheard of. The bear case says the company is burning through its cash at an alarming rate. That $217 million TTM net loss is the single biggest risk. The recent $200 million financing wasn't for expansion, it was for survival. The risk is that the company will have to continuously sell more shares, diluting the value of the existing ones just to keep the lights on. The bears see the executive announcements and investor conferences not as signs of strength, but as a desperate attempt to prop up the stock price so they can raise more capital. This is a good moment for some reflection. Comment below with your thoughts. Is Rezolve's Agentic Commerce a real business, or is this just another post-SPAC narrative? Ultimately, the story of Rezolve AI is a perfect example of the tension between market narrative and financial fundamentals. The expectation is that you are buying into an AI-driven future of commerce, a story that is easy to sell and exciting to believe in. The reality is that you are buying a non-profitable, high cash burn recent de-SPAC that is almost entirely dependent on its ability to sell this story to new investors to fund its operations. This isn't a stock for a stable, intelligent portfolio or a diversified Fidelity mutual funds holding. It's a binary bet. Either the company achieves its moonshot revenue targets and the stock explodes higher, or it fails, runs out of cash, and the stock collapses. The market is telling you this every day with its extreme volatility. The disconnect between the billion-dollar-plus valuation and the single-digit million revenue is the entire story. The bulls are betting on the narrative. The bears are betting on the math. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment